Welcome to the daily insights that matter. India's debt to GDP ratio is projected to reach 82.3% in fiscal year 25 and then gradually decline to 80.5% in fiscal year 29 according to the latest estimates by the International Monetary Fund in its Fiscal Monitor report. As we all know, the COVID-19 pandemic had a significant impact on the Indian economy, leading to a substantial decrease in government revenues and an increase in government spending. This caused India's public debt to GDP ratio to surge from 75% in fiscal year 20 to 88.5% in fiscal year 21. Fortunately, it started to gradually decrease to 81% in fiscal year 23 as both revenues and expenditures stabilized. However, the IMF now projects that it will rise again over the next two fiscal years in fiscal year 24 and fiscal year 25. Interestingly, this revision by the IMF is quite substantial when compared to its April projections, where it indicated that India's debt to GDP ratio would follow an upward trajectory for 4 fiscal years starting in fiscal year 24 and reaching 83.8% in fiscal year 27. Now, when we discuss debt, it is essential to understand that it serves a necessary tool for any government's economic growth. It provides the crucial funding required for investments, ultimately stimulating economic development. The only time we should be concerned about debt is when it coincides with political instability and mismanagement. It's worth noting that despite these numbers appearing high, India actually maintains one of the lowest debt to GDP ratios when compared to other economies. This indicates a certain level of fiscal responsibility and prudence in managing its debt. Furthermore, India's external debt situation seems to be reasonably comfortable. If you're interested in delving further into India's debt position, you can find out detailed information in our Third Empire videos. Money flowing into mutual funds is on the rise and investors are jumping on board, especially through systematic investment plans or SIPs to make the most of market swings. In fact, in September, SIP contributions hit an all-time high, crossing the 16,000 mark for the very first time. According to data released by AMFI, which is a regulatory body of mutual fund houses in India, the total contributions for the month of September stood at 16,042 crores compared to the 15,814 crores in August. The mutual fund industry also witnessed the number of unique investors crossing the massive milestone of 4 crores. However, the flip side was that equity mutual fund inflows dropped 30% in September to 14,091 crores from 20,245 crores on account of profit booking by investors. Despite the volatility and uncertainty in global markets, net inflows in local equity funds have continued to remain in positive territory for the 31st consecutive month. SIP contributions crossing the 16,000 crore milestone and reaching an all-time high is a testament to the resilience of the Indian markets. Additionally, the SIP flows from investors and domestic institutional investors have acted as a powerful counterforce against FPIs who pulled out 14,767 crores in September and 8,000 crore in the first week of October. Having said that, this is me, Ralasan, signing off. Have a great day and stay safe.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.
Equity investments are subject to market risk. Read all investment-related documents carefully. Visit www.researchandranking.com